Hello and welcome to Investment Insight. Before we begin, make sure to subscribe and hit the like button. Now let's break down what's happening in the markets today in a clear and simple way.
Thanks for having me.
So I want to start by setting a little scene. Let's imagine it's May or June of 2026. You are driving to work.
Probably stuck in traffic.
Right, exactly, stuck in traffic.
Yeah.
You're listening to the news and you hear that Russia is pumping out more raw crude oil right now than they have in months.
Which sounds like great news for the consumer.
Yeah, logically, as an everyday American investor or just someone buying gas, you hear that and think, well, the price of gas at my local station is about to plummet. I mean, more supply means lower prices, right?
You would certainly think so.
But it doesn't happen. The prices stay super volatile. So today, for this deep dive, we're going to look at some recent analysis to explain exactly why an abundance of Russian oil is actually a pretty complex warning sign for your wallet.
It really is.
We're decoding this massive geopolitical puzzle, basically Russia's internal financial reality, and what it actually means for the American economy, especially as we navigate the markets under the current Trump administration.
Yeah, and to really grasp this, the broader context here is a major shift in how international financial crises even operate nowadays.
What do you mean?
Well, if you think back to 2022, the immediate fear with Russia was direct financial contagion. Wall Street was, absolutely terrified of a domino effect in the global banking system.
Kind of like the 2008 financial crisis.
Exactly like 2008, people were really worried that if Russian banks defaulted, the major Western banks that held all that Russian debt would just collapse.
Right, but according to the current data, that direct link is, well, it's effectively gone now, isn't it? Like the direct wires have been cut.
They have, completely. Russian stocks, Russian bonds, they've been systematically purged from Western portfolios over the last few years. Yeah, and to give you a sense of scale on just the physical decoupling, European reliance on pipeline gas from Gazprom, which is the Russian state-owned company, that has plummeted by 44%.
44%. That's massive.
It's huge. That brings European pipeline imports down to levels we literally haven't seen since the mid-1970s. So the direct financial blast radius is heavily contained at this point.
So basically, if a financial bomb goes off in Moscow today, it doesn't immediately shatter the windows on Wall Street.
Right. Not directly.
But that doesn't mean we don't feel the shockwave. The data shows the impact it's shape-shifted. Instead of hitting our bank stocks directly, it's hitting global supply chains, commodity markets, and of course, inflation rates.
And understanding that new ripple effect really requires us to look at the source of the disruption. We have to examine how financially strained the Russian economy actually is right now behind closed doors.
Right. And to make sense of that macroeconomic data, I want to use a really simple everyday analogy for our listeners.
Go for it.
Think of the Russian economy right now, like a family that is just maxing out all of their credit cards to pay for this massive top-of-the-line security system for their house.
That's a really good way to frame it.
Right. So to afford all these cameras and guards, they have to slash their grocery budget, they stop fixing the leaky roof, and they just take on incredibly toxic high-interest debt.
Just to keep that one security project going.
Exactly. So from the outside, the house might look fortified, but inside, the family is basically starving and the foundation is rotting.
Yeah, and the June 2026 economic data mirrors that exact hollowing out process perfectly.
What do the numbers actually say?
Well, Russia's GDP growth forecast for 2026 has been drastically slashed. It went from a modest 1.3% down to a mere 0.4%.
Oh, wow. So essentially flatlining.
Pretty much. And looking ahead to 2027, the projection was downgraded from 2.8% down to 1.4%. The underlying civilian economy is essentially stalling out.
Because, going back to the analogy, all the money is going to the security system. The war effort is literally consuming everything else.
Exactly. The prioritization is stark. In early 2026, the government actually debated a 10% across-the-board cut to what they categorize as non-sensitive civilian sectors.
Let me guess. Non-sensitive means anything that doesn't shoot or explode.
You nailed it. It refers to civilian infrastructure, education, healthcare, local government support, all of it. They are methodically defunding the systems that generate long-term domestic growth just to pay for immediate short-term military operations.
Wow.
And to manage this, they are applying what analysts call a triple squeeze on their own economy.
Okay, let's unpack this triple squeeze. What's the first one?
The first squeeze is taxation. They are hiking taxes to generate immediate cash flow. The research mentions increases in the value-added
Which
tax.
is basically like a national sales tax, right?
Right, exactly. Plus, they are raising corporate taxes.
Man, if you are a civilian business owner in Russia right now, a corporate tax hike combined with a drop in consumer spending because of the sales tax increase, that just sounds like a complete death spiral.
It creates an incredibly hostile environment for domestic enterprise, yeah. And that leads directly into the second squeeze, which is the reduction in non-military spending we just discussed.
Oh, right. Because without government investment in roads or bridges or technology, those heavily taxed businesses have even less infrastructure to support them.
Precisely. They're paying more and getting much, much less.
But it's the third squeeze that I find really baffling, honestly. The trapped central bank.
This is a wild one.
Yeah, because the data says the Russian central bank cut interest rates in February 2026 down to 15.5%. Wait, 15.5% is the cut.
That was the lower rate, yeah.
I mean, for an American investor who starts panicking when mortgage rates hit, like
Yeah.
7%, a 15.5% interest rate sounds like an apocalyptic scenario. How does a modern economy even function at that level without instantly imploding?
Well, the mechanics of managing a wartime economy are vastly different from a peacetime one. When a government redirects its factories to produce tanks and artillery instead of, say, washing machines and cars, consumer goods become scarce.
And scarcity drives up prices.
Exactly, which creates inflation. Now, normally, a central bank raises interest rates to cool down spending and halt inflation. But the Russian central bank is in a trap.
Because if they raise rates any higher than 15.5%,
Civilian businesses taking out loans to survive will simply go bankrupt immediately.
oh, I see. So they lowered it to 15.5% to throw a tiny lifeline to those local businesses.
They did, but it's a huge risk. By lowering rates while massive government war spending continues, they risk pouring absolute gasoline on the inflation fire. They are literally walking a tightrope between mass civilian bankruptcies and hyperinflation.
So let me push back a bit here. If they are struggling so much at home, won't the whole system just collapse tomorrow?
Financial strain does not equal immediate collapse.
Right.
They managed to avoid a sudden implosion through really strict capital controls.
Which means making it illegal for money to leave the country.
Right, and by forcing their energy exporters to convert all their foreign profits into rubles just to prop up the currency.
Okay, so they aren't going to disappear in a puff of smoke tomorrow. They have workarounds, but the foundation is definitely cracking.
The long-term structural health is draining away completely, which really forces us to look at how they are actually funding all this.
Right, the paycheck. The money has to come from somewhere, and for Russia, that means energy, oil, and gas. But the recent analysis we reviewed shows this paycheck is shrinking dramatically.
Yeah, let's look at the numbers. The federal budget projections for 2026 expected oil and gas revenues to bring in about 8.92 trillion rubles out of a total budget of roughly 40 trillion.
So they were banking on energy to cover roughly 20% of all federal spending.
Exactly. But from January to May of 2026, cumulative energy revenue dropped by a third compared to the previous year. It landed at just 3 trillion rubles.
Now wait, I have to push back here based on recent history. In May 2026, the conflict involving Iran caused global oil prices to totally spike. When crude oil gets more expensive globally, shouldn't Russia be swimming in cash?
You'd think so, but a global price spike really just provides a temporary windfall. It doesn't fix a structural deficit.
Right, it's just a blip.
Exactly. That May price spike in the Middle East boosted Russia's monthly energy revenue by an estimated 39% year over year for that specific month. But when we look at the cumulative January to May numbers, they were still down by a third overall.
So a brief geopolitical shock is basically just a Band-Aid. It doesn't repair a fundamentally broken export model.
Couldn't have said it better.
Which brings us back to the scenario from the very beginning of the show. To make up for this missing money, Russia started pumping raw crude oil like crazy. The data shows exports from their western ports hit 2.5 million barrels a day in May 2026.
The highest since September 2025.
Right. So if there is that much crude oil flooding the market, why doesn't that bring down the cost of a gallon of gas for an American consumer?
Because the bottleneck lies in the refining process. You have to remember, you cannot pump raw crude oil directly into a commercial airliner, nor can you put it into the 18-wheeler delivering goods to your local supermarket.
Right. It's basically useless until it's processed.
Exactly. Raw crude must be heated, separated, and cracked into specific hydrocarbon chains to create usable products like diesel, aviation fuel, and gasoline.
And Russia's ability to do that has been crippled recently.
Very severely. Extensive Ukrainian drone strikes have specifically targeted and heavily damaged Russian oil refineries. So Russia possesses the raw material, but their factories designed to process it are either offline or just heavily degraded.
So they are forced to export the raw crude because they literally cannot process it domestically.
That's right.
The analysis even noted they had to ban the export of jet fuel just to guarantee they had enough for their own domestic flights. And they were seriously considering bans on diesel exports as well.
And this creates a really critical distinction for everyday investors. Watching the global price of raw crude oil no longer gives you the full picture of inflation risk.
It's misleading now.
Very. The real danger has shifted to the refined products market. If global supplies of diesel and jet fuel become unpredictable, the profit margins for the remaining operational refineries worldwide will just swing wildly.
Wow. Let's unpack the shadow fleet that was mentioned in the research too, because this directly impacts those price swings. If they are exporting this crude, how are they moving it while under all these heavy international sanctions?
They utilize a massive decentralized network of aging maritime vessels. These ships operate completely outside standard Western insurance and regulatory frameworks.
So they're just going rogue.
Basically,
Yeah.
they often turn off their tracking transponders to avoid detection, and they frequently transfer oil to other ships right in the middle of the ocean just to obscure the origin of the product.
But operating in the shadows like that isn't cheap.
It is incredibly expensive.
Yeah.
Using older, less efficient ships, paying insane premium rates for non-Western insurance, and navigating these longer, really convoluted trade routes, it all adds massive logistical friction.
And all of those increased maritime shipping costs eventually trickle down into the global supply chain, which hits us at the register.
Exactly.
Now, because Russia can't rely on those refined oil profits to fund their operations, they're leaning heavily on another major lever they control. And this is one that directly impacts the American wallet in a huge way.
The global food supply.
Right. The agricultural ripple effect here is profound. I always explain fertilizer to new investors as the ultimate hidden tax on your grocery receipt.
That's just a great way to put it.
Because, you don't buy bags of industrial fertilizer at the store. But natural gas is a primary component in manufacturing nitrogen fertilizer. So because energy and agriculture are tied together, fertilizer dictates the cost of growing wheat. The cost of wheat dictates the cost of flour. And flour dictates the price of your morning cereal and your bread.
And the scale of Russia's influence over these baseline ingredients is just massive. Based on the research, the combined output of Russia and Ukraine accounts for roughly 30% of all global wheat exports.
30%.
Yeah. Furthermore, Russia is the world's single largest exporter of fertilizer.
And the 2026 Iran conflict created a perfect storm for global agriculture here.
It really did. The Middle East is traditionally a major hub for fertilizer production and logistics, so the 2026 conflict severely disrupted those facilities.
Right.
With Middle Eastern supplies suddenly taken offline or facing severe delays, the global agricultural market became desperately dependent on Russian fertilizer just to bridge the gap.
So a financially desperate Russia, looking for any way to fund its military, suddenly finds itself holding a massive portion of the world's fertilizer supply, just as global demand spikes.
They have a tremendous point of leverage. If the Russian government decides to implement aggressive export taxes on their fertilizer, or if they institute strict quotas to artificially constrain global supply, they can manipulate the price to extract maximum capital for their war effort.
Okay, let's translate this into the food inflation tail risks mentioned in the data. What does that actually mean for the listener? Because we aren't talking about empty supermarket shelves in the United States, right?
Yeah.
America has a massive, highly developed domestic agricultural sector.
Right. And no, an instant famine in the U.S. is not the concern here. A tail risk refers to a low probability event that carries a massive financial impact if it occurs. In this context, the immediate danger is the destabilization of emerging markets. Countries across the Middle East, North Africa, and South Asia are highly sensitive to the cost of imported grain and fertilizer.
Because if the price of bread doubles in a country already struggling economically, you don't just get inflation, you get massive social unrest.
Exactly.
So let's trace how that hits a 401k for our listeners. A beginner investor might have their retirement money in a mutual fund that tracks international growth. That fund likely holds emerging market bonds, which is essentially debt issued by governments in places like Egypt or Indonesia.
And when food prices spike, those governments have to spend their foreign currency reserves subsidizing food to prevent riots.
Right.
That drains their national treasury. Consequently, international currency markets lose faith in that nation's economy, which leads to currency devaluation. As the currency plummets and the risk of the government defaulting on its debt rises, the value of those government bonds held in American mutual funds drops significantly.
Wow. So it is an indirect but highly destructive financial contagion.
Mm.
Literally, a fertilizer quota in Moscow can devalue a retirement portfolio in Chicago through a currency crisis in North Africa.
The interconnectedness of these commodity markets simply cannot be overstated.
So let me summarize where we are. We have a country running out of money, severely damaging its long-term domestic economy, and resorting to weaponizing basic commodities like unrefined crude and fertilizer just to survive month to month.
Yes.
The logical conclusion most people would jump to is, well, they are going to run out of cash, they won't be able to afford the war, and they will be forced to stop fighting.
It makes sense on paper, but the data points to a very different and counterintuitive outcome.
Which is?
Financial strain does not automatically guarantee peace. The research highlights statements from EU foreign policy official Kaja Kallas in late May 2026.
What did she say?
She observed that while the momentum on the battlefield is shifting and Russia is increasingly on the defensive, the pressure must be maintained because Russia isn't surrendering. They are adapting.
Adapting how? Like if you can't afford a wildly expensive war, you just pivot to a cheap war.
Exactly. Conventional warfare is incredibly capital intensive. Maintaining supply lines for heavy armor, paying thousands of troops, manufacturing millions of artillery shells, that drains a treasury rapidly. To counter their financial squeeze, Russia is pivoting to asymmetric warfare.
Okay, let's clearly define asymmetric warfare for the listeners. What does that shift actually look like in practice?
Asymmetric warfare involves using low-cost, unconventional tactics to inflict massive damage on a superior or wealthier conventional force. So instead of launching a multi-million-dollar cruise missile, you deploy a swarm of cheap, mass-produced aerial or naval drones that maybe cost a few $1,000s each.
Right, just overwhelm the defenses.
Exactly. You heavily fund state-sponsored cyber attacks, which require very little physical infrastructure but can completely paralyze a target nation's banking system, hospital networks, or power grids.
The research also mentioned threats to subsea internet cables and offshore energy platforms, right?
Yes. Damaging a subsea data cable requires minimal investment, maybe a small submersible or a modified fishing vessel, but it can disrupt billions of dollars in global financial transactions instantly. It is all about achieving the maximum possible disruption for the absolute lowest financial cost.
This represents a massive paradigm shift for anyone investing in the defense sector. I mean, a casual investor might read the headlines about Russia's economic struggles and think, well, the threat is diminishing, the war is winding down, so European defense stocks have probably peaked. It's time to sell and collect a peace dividend.
Relying on that assumption would be a critical misread of the structural market changes happening right now. The geopolitical threat isn't evaporating. It is mutating into a form that requires completely new defensive architectures.
So European nations and their allies can't just stop spending money on defense. They have to change what they are buying to counter this cheap war.
Exactly. The structural demand is shifting away from traditional heavy armor and moving toward highly specialized technology.
Like what specifically?
There is an immense long-term need for companies developing advanced drone countermeasures, sophisticated radar systems capable of tracking low-flying autonomous swarms, cutting-edge cybersecurity infrastructure, and technologies specifically designed to monitor and protect critical maritime assets.
Okay, so based on all of this, the hollowing out of the Russian economy, the refinery bottlenecks, the fertilizer leverage, and this major shift to asymmetric warfare, let's build an American investor's playbook. What does the recent data tell us about positioning a portfolio right now?
The most prominent takeaway is a strategy of redirection. The data firmly suggests you should avoid any attempt to invest in or short Russia directly.
Yeah, I mean, trying to time a market dictated by unpredictable state sanctions, retaliatory export bans, and shadow fleets, that's a gamble, not an investment strategy.
Exactly. The smart capital is looking at the alternatives. The global economy still requires energy and food, obviously, so you need to analyze which regions and companies are structurally positioned to fill the void left by a volatile Russia.
Let's give some concrete examples from the research, starting with energy. Russian liquid natural gas, or LNG, is facing massive logistical hurdles, high insurance premiums, and increasingly strict sanctions. And European buyers are actively working to phase it out completely.
This creates a huge structural advantage for reliable alternatives. American LNG exporters stand to gain significant market share here. Similarly, LNG suppliers in regions like the Middle East and Australia benefit, as they offer the geopolitical stability and clear logistical pathways that Russia has forfeited.
Okay, turning to the agricultural side. If Russian fertilizer and grain exports are highly volatile and subject to political manipulation, where does the agricultural investment pivot?
The pivot moves towards stable, highly developed agricultural sectors. North American fertilizer companies are prime candidates to capture increased demand.
Like so.
And for broader agricultural production stability, the data points toward major producers in regions far removed from the immediate conflict zones, nations like Brazil, Australia, and Canada.
Fantastic. Finally, we established earlier that watching the spot price of raw crude oil is a trap because of the refinery bottleneck. So how do everyday investors track the real energy risk?
The focus must shift to the margins on refined products. Investors should be monitoring the companies with the operational capacity to actually refine crude into diesel and aviation fuel.
Right.
Additionally, the maritime shipping sector becomes crucial here. Companies that manage the complex logistics of safely moving these refined products across longer, shifting trade routes in an era of heightened sanctions, they hold significant pricing power right now.
So the entire landscape is just fundamentally different than it was a few years ago. The immediate panic of a global banking collapse has faded, but the secondary shockwaves are persistently working their way through the physical supply chains of everyday goods.
Exactly. And I think there's a really important final thought here for people to ponder.
What's that?
In geopolitics, a cornered, financially strained player doesn't always surrender. Sometimes they just change the rules of the game to become more unpredictable. Keep your eyes on the supply chains, not just the headlines. Consider how this pivot to asymmetric warfare permanently alters the United States' own long-term strategy, too.
Oh, that's a great point.
If the new global threat environment is defined by cheap drones and cyber attacks on civilian infrastructure, how will that reshape U.S. domestic tax spending and federal defense contracts over the next decade? We may be entering an era where the most valuable defense contractors are no longer the ones building fighter jets, but the ones writing algorithms.
It is a profound shift in where capital will flow. Well, that is all the time we have for today. Don't forget to subscribe and hit that like button.